What if the psychology of money is wrong? This book has 4.5 stars on Amazon. Over 500,000 copies sold. Warren Buffett praised it. Bill Gates recommended it. Every finance YouTuber says it changed their life. And today, I am going to argue that Morgan Housel might be wrong. Not because I want to be contrarian, not because I am smarter than him, but because what works for a millionaire author might not work for you. What if the psychology of money is wrong? Here's what bothers me about book reviews on YouTube. Everyone just agrees. They summarize the lessons, nod along, tell you to buy it. Nobody questions anything. It's like we have all decided that once a book gets popular enough, it becomes gospel truth. But the best way to find truth is not to just accept arguments. It's to steelman the opposition. That means taking the strongest possible counterargument and presenting it with full conviction, not a weak version, the best version of the opposite view. So today, I am presenting 10 of Morgan Housel's biggest lessons from the psychology of money, and then I am going to argue the complete opposite of each one, with real evidence, with people who got rich doing the opposite of what this book recommends. And then, I am going to let you decide which philosophy actually fits your life. Because here's what nobody tells you: context matters more than advice. Look, I need to be clear. I actually like this book. I've recommended it to friends. There is genuinely great wisdom in here. But Morgan Housel is a millionaire. He made his money as a writer and investor. He has financial security. A lot of his advice, like paying off your mortgage for peace of mind or being satisfied with enough, makes sense for someone in his position. But what if you are 25 with $80,000 in student loans? What if you are 35 and just realized you are 10 years behind on retirement? What if you are making $45,000 a year in a high-cost city? Does the same advice apply? I do not think so. The video structure. Here's how this works. For each lesson, I will give you 4 things. 1. I will present Housel's original lesson fairly and accurately. 2. I will argue the opposite with full conviction. 3. Real examples of people who succeeded with both approaches. 4. A tough question, then my honest conclusion. I am not telling you which one is right. Your income, your timeline, your risk tolerance, your goals, those determine your strategy. Not a book. Not me. Counterargument number 1. Enough is a poverty mindset. Housel says, define enough. One of the most powerful lessons in the psychology of money is this: you need to define enough. Housel tells the story of Rajat Gupta, who had $100 million but risked everything for just a little more and ended up in prison. Bernie Madoff, same story. Rich people who destroyed their lives because they could not say enough. Housel's advice is simple. Pick a number, a lifestyle, a level of wealth where you say, this is enough. I am satisfied. I will not risk this for more. He even says the hardest financial skill is getting the goalpost to stop moving. It sounds wise, right? Sounds mature, responsible, grounded. But what if that is completely wrong? But what if enough kills ambition? Okay, let's be honest. When I hear enough, I hear settle. I hear play it safe. I hear stop dreaming. Think about every person who changed the world. Elon Musk did not say enough after PayPal sold for $180 million. He could have retired at 30 and lived like a king. Instead, he risked everything on Tesla and SpaceX. Multiple times, he was on the verge of bankruptcy. Today, he is the richest person in the world, and he is pushing humanity to Mars. Jeff Bezos did not say enough after Amazon successfully sold books. He could have been satisfied with a comfortable online bookstore. Instead, he kept pushing everything from cloud computing to space exploration. Sarah Blakely invented Spanx with $5,000. When she hit her first million, she could have said enough. When she hit $100 million, she could have said enough. But she did not. She kept pushing. Today, she is worth over $1 billion. She has created thousands of jobs. She has donated millions to charity, and she has inspired a generation of female entrepreneurs. You know what enough gets you? They're comfortable, safe, modest, and you know what? For some people that is perfect, but for the people who build empires, cure diseases, create jobs, and push humanity forward, they refuse to accept enough. The goalposts should move. That is not greed. That is evolution. That is growth. That is ambition. Do you know what happens to people who get comfortable? They stagnate. They stop growing. They wake up at 50 and realize they played it safe their entire lives and they have regrets. Here is what really bothers me about this advice. And who gets to define enough? Morgan Housel already has wealth. He already has freedom. He already has financial security from book sales and investments. So it is easy for him to say stop chasing more when he has already achieved more. But what about the person who is just getting started? What about the person who grew up poor and wants to build generational wealth for their family? What about the person who has a vision that requires resources to execute? Are we supposed to tell them, sorry, you should be satisfied with comfortable? Enough can be wisdom, but it can also be fear disguised as maturity. It can be an excuse to stop pushing, to stop growing, to stop becoming who you could be. The question is, are you protecting what matters, or are you settling because you are scared to want more? Real-world evidence. Let me show you two people, same starting point, different philosophies, completely different outcomes. Sarah Blakely invented Spanx with $5,000 in savings. She had every opportunity to say enough along the way. First million? No. 10 million? Enough. 100 million? Enough. But she kept pushing, not because she was greedy, but because she had a vision. She wanted to empower women. She wanted to build a brand that mattered. Today, she is worth over $1 billion. She has created thousands of jobs. She has donated millions to charity. She has changed entire industries. If she had stopped at enough, none of that impact would exist. Now, let me tell you about James. I interviewed him for this video. At 35, James had $2 million in investments, a paid-off house, and a lifestyle that cost $60,000 a year. He did the math. He had enough, so he said enough. He stopped pushing in his career. He retired early. He thought he had found peace. 15 years later, he told me something that stuck with me. I thought I had found peace, but peace turned into boredom, and boredom turned into regret. I did not realize that enough money does not mean enough purpose. He watches his former colleagues building companies, making real impact in the world, and he wonders, what if I had not stopped? What if I had kept growing? James is not broke. He is fine financially, but he feels like he stopped living at 35. So here is the question you need to ask yourself, and be brutally honest. Is Morgan Housel telling you to settle because he genuinely wants you to find peace and contentment? Or is he telling you to settle because he already has his millions? Millions he made from selling books that tell you not to chase millions. Think about that for a second. The man made a fortune writing about how you should not chase fortune. Now, I am not saying he is wrong. I am not saying he is a hypocrite. I am saying you need to know the difference between healthy contentment and giving up on your dreams because you are scared. Big difference. Takeaway. Here is what I actually believe. If chasing more is destroying your relationships, your health, your peace of mind, your family, your values, then Housel is absolutely right. Stop. Define enough. Protect what matters. But if enough feels like settling, if you have dreams you have not chased yet, if you are using contentment as an excuse to avoid taking risks that scare you, then maybe you need to push further. The question is not, should I want more? The real question is, what is driving you? Fear or purpose? Greed or mission? Ego or impact? Answer that question honestly, with brutal self-awareness, and you will know which path is yours. Right, that is one down. 9 more to go. Counter-argument number 2. Patience is for people who can't compete. Housel says, Time in market beats timing. Chapter 4 of the book is all about the secret weapon of wealth building, compound interest over time. Housel shows that Warren Buffett didn't get rich because he's a genius, although he is. He got rich because he started investing at age 10 and never stopped for 84 years. Here's the stat that blows people's minds. 96% of Warren Buffett's wealth came after his 65th birthday. Not before, after. The lesson is clear. Don't try to get rich quick. Don't try to time the market. Don't chase hot stocks. Just start early, invest consistently in boring index funds, and let time do the heavy lifting. Be patient. Stay invested for decades. Ignore the noise. That's how real wealth is built. It's one of the most repeated pieces of advice in all of finance. And for good reason. It's mathematically true, it's proven by data, it works. But here's the problem. But what if you don't have 40 years? Okay, let's do some uncomfortable math. Warren Buffett started investing at 10 years old. He's 94 now. That's 84 years of compounding. 84 years. Do you know what that means if you're watching this video? You're already behind. Way, way behind. If you're 25 right now and you follow this advice religiously, you'll be wealthy at 65. Congratulations. You'll have money right when your knees hurt, when you can't travel like you used to, when half your friends are dealing with serious health issues, when your energy is a fraction of what it is now. You traded the prime years of your life, your youth, your vitality, for security in old age. And maybe that's okay, but maybe it's not. Here's what really bothers me about the just be patient for 40 years advice. It assumes you have 40 years. It assumes no medical emergencies that wipe out your savings. It assumes no layoffs that derail your investment plan. It assumes no divorces that split your assets. It assumes no aging parents who need financial help. It assumes no once-in-a-lifetime opportunities that require capital now, not in 40 years. It assumes your life will be stable, predictable, and linear. But how many lives actually work that way? The people who got rich from Bitcoin didn't wait 40 years. They took a calculated risk in 2013 when it was $100, did their research, understood the technology, and retired at 30. The people who bought Tesla stock in 2019 didn't need decades of compound interest. They 10x'd their money in 18 months. The people who started businesses didn't wait for index funds to slowly grow. They bet on themselves. They took risk. They moved fast. Now, were these approaches riskier than index funds? Absolutely. Did everyone who tried them succeed? Hell no. But the point is this: be patient for 40 years is advice for people who can afford to be patient. It's advice for people with stable jobs, no crushing debt, and no urgency. But what if you're drowning in student loans? What if you're already 35 and have nothing saved? What if you want to retire before your body gives out? What if you want to build wealth while you're still young enough to enjoy it? The world moves faster now than it did in 1960 when Buffett was building his wealth. Technology changes in years, not decades. Entire industries are created and destroyed in the time it used to take to build a single company. Waiting 40 years with a 1950s strategy in a 2025 world might mean you never catch up. You might be playing a game that doesn't exist anymore. Real-world evidence. I want to show you two very different paths to wealth. Both people started the same year, 2013. Same age, 25 years old. Completely different strategies. On the left, Michael bought Bitcoin in 2013 when it was $100 per coin. Everyone told him he was an idiot. Just put it in index funds, his friends said. Be patient, follow the proven path. But Michael did his research. He spent months understanding blockchain technology, the potential, the risks. He risked $10,000, money he could afford to lose completely without ruining his life. By 2017, that investment was worth $1.7 million. He sold most of it. He retired at 30. Today, he travels the world, works on passion projects, has complete financial freedom, and he's 35 years old. He didn't wait 40 years. On the right, Jennifer. Jennifer did everything the book says. She started investing in index funds at 25. She She put in $500 every single month religiously, no matter what. She never touched it, never tried to time the market, never panicked during crashes. She followed the rules perfectly. She's 45 now. Her portfolio is worth $430,000. That's great. That's doing exactly what the math said it would do. The plan is working, but she's still working a full-time job. She's still living paycheck to paycheck in many ways. She'll have to keep working for another 15 to 20 years before she can retire. Meanwhile, Michael has been free for 15 years. Now, Michael took massive risk. Jennifer took almost no risk. But Michael's risk was calculated. He educated himself. He only risked money he could lose, and it changed his entire life trajectory. So let me ask you this. How many young people actually have 40 years of patience? If you're 25 with $80,000 in student loans, $15,000 in credit card debt, rent that takes half your paycheck, and you're barely making ends meet, does be patient for 40 years even make sense? Or is patience just advice for people who are already comfortable, who already have safety nets, who can afford to wait? What if patience is a luxury you can't afford? What if you need results faster because your situation is urgent? That's the question nobody asks. Key takeaway. Look, Housel isn't wrong. If you have stable income, time on your side, and you can handle the emotional roller coaster of market volatility, patience absolutely works. It's proven, and it's reliable. It's mathematically sound. But if you're starting late, if you have debt crushing you, if you have goals that can't wait 4 decades, then you might need to take bigger, smarter, more calculated risks. Just be honest about which camp you're in. Don't lie to yourself, because picking the wrong strategy for your situation is worse than picking either strategy. The question isn't, should I be patient? The real question is, can I afford to be? So that first. Counterargument number 3, debit is a tool, not a trap. Housel says, avoid leverage. In one of the most personal chapters of the book, Housel shares something vulnerable. He and his wife paid off their house completely. No mortgage, 0 debt. He admits it was probably the worst financial decision they ever made, mathematically speaking. The numbers say they should have kept the low-interest mortgage and invested that money elsewhere for higher returns. But it was the best decision for their peace of mind. His philosophy is this: you can be technically right and still wrong for your emotional well-being. He'd rather sleep well at night than optimize every single percentage point of return. He also keeps 20% of his portfolio in cash. Again, mathematically inefficient, but emotionally right. It's honest. It's vulnerable. It's refreshing. And for many people, it's exactly the right approach. But for others, what if debt built every fortune? Let me tell you how every major fortune in history was actually built. Debt, leverage, other people's money. John D. Rockefeller didn't pay cash for everything. Andrew Carnegie borrowed massively to build his steel empire. Cornelius Vanderbilt used leverage to dominate railroads. Fast forward to today. Jeff Bezos, Elon Musk, every single one of them used massive amounts of debt to build their empires. They didn't pay cash because it felt emotionally comfortable. They understood that debt is a tool, and tools can build things. Let's do the math that Housel conveniently doesn't show you in detail. Imagine you have a $500,000 house. Option A, you pay it off completely. You own it. 0 debt. You sleep like a baby. It feels amazing. Option B, you put 20% down. That's $100,000. You finance the remaining $400,000 at 3% interest, and you invest that $400,000 you didn't tie up in the house into the S&P 500, which historically returns about 10% annually. Over 30 years, what happens? Option A, you own a $500,000 house. That's it. Option B, you own a $500,000 house and you have approximately $2.8 million in additional investments. Same house. But one path leaves you with nearly $3 million more. That's the actual cost of emotional comfort, $2.8 million. Here's what really bothers me. Rich people use other people's money constantly. It's literally how they stay rich and get richer. But when working class people or middle class people use debt, we call it irresponsible. We shame them. We tell them they're living beyond their means. But the difference isn't debt itself. The difference is financial education. The difference is understanding good debt versus bad debt. Good debt, borrowing at 3% interest to buy an asset that generates 10% returns. That's a 7% arbitrage. That's smart. Bad debt, borrowing at 19% interest on a credit card to buy a TV that loses value the moment you unbox it. That's dumb. Debt isn't moral or immoral. It's a tool. And tools are only as good or as dangerous as the person using them. Real-world evidence. Let me introduce you to two real estate investors. Same city, same market, same starting year, completely different strategies. First, David. David saved for years to buy his first rental property in cash. $400,000. No debt. No mortgage. He was incredibly proud. He felt secure. The property generated $2,000 a month in rent. After expenses, property tax, insurance, maintenance, he netted about $15,000 per year. Over 10 years, he made $150,000. Not bad. Solid return. Safe. On the right, Maria. Maria took that same $400,000, but instead of buying one property in cash, she used it as 20% down payments on 5 properties, worth $2 million total. Each property generated positive cash flow even after making mortgage payments. Over those same 10 years, the properties appreciated in value. She paid down the mortgages with rental income, and her total net worth increased by $1.2 million. Same amount of starting capital, 8 times the return. Now, Maria took more risk. Absolutely. She had 5 mortgages to manage instead of 0. If the market crashed hard, she was more exposed. But here's what people miss. Maria educated herself. She ran the numbers obsessively. She built in safety margins. She understood cash flow, cap rates, and market cycles. Her use of debt wasn't reckless gambling. It was strategic leverage. That's the difference. So here's what you need to ask yourself, and this is uncomfortable. Is Morgan Housel's paid-off house advice financially optimal? Or is it just emotionally comfortable? And more importantly, are you choosing comfort over wealth? Are you choosing the feeling of safety over actual financial freedom? Because here's the brutal truth. If you don't understand debt, if you can't handle the stress, if you haven't educated yourself on how leverage works, then Housel is absolutely right for you. Pay off your debt, all of it. Sleep well. But if you understand the math, if you can handle the emotional weight, if you have the discipline and education, you might be leaving millions of dollars on the table just for peace of mind. Is that peace of mind worth $2.8 million to you? Only you can answer that. Key takeaway. Here's my take. Debt is like a chainsaw. In the wrong hands, it cuts you. It destroys you. In the right hands, it builds a house. It creates wealth. If you don't understand interest rates, cash flow, risk management, market cycles, pay off your debt, all of it, Housel is right for you. Do what he did. But if you're financially educated, if you run the numbers, if you build in proper safety margins, if you understand what you're doing, leverage can 10x your wealth. The rich know this. That's why they stay rich. The question isn't, should I use debt? The real question is, am I educated enough to use it safely? Be brutally honest with yourself, because the wrong answer in either direction will cost you everything. Counterargument number 4. You are not actually playing the long game. Housel says, stay invested through crashes. One of Housel's core teachings is about staying invested no matter what. Never panic sell. Ignore market crashes. Ignore recessions. Ignore fear. He tells the story of 3 investors. Sue, who invested every single month from 1900 to 2019 no matter what. Jim, who only invested when the economy wasn't in recession. And Tom, who panicked during recessions and waited 6 months after each one ended to reinvest. After more than a century, Sue ended with $435,551. Jim ended with $257,386. Tom ended with $234,476. The lesson is crystal clear. Stay invested. Always. Through every crash, every panic, every recession. Just hold on and never let go. Time in the market beats timing the market. It's one of the most fundamental rules of investing. But here's what nobody talks about. But what if life doesn't wait for your plan? Okay, this stay invested forever advice assumes something crucial, that your life is predictable, that you'll never have an emergency that forces you to sell, that you'll never need the money before your arbitrary retirement date. But is that realistic? Let's talk about what actually happens in real life. You're 35, fully invested in index funds following Housel's advice. Then your spouse gets sick. Medical bills pile up. Insurance doesn't cover everything. You need $50,000 immediately. What do? Well, if the market is down 40% like it was in 2008, you're forced to sell at the worst possible time. You just locked in massive losses that you'll never recover. Or imagine you lose your job during a recession. You need to pay rent, buy food, survive. Your emergency fund runs out. Only option is to sell investments, again at the worst time. Here's what really bothers me about the always stay invested advice. It ignores liquidity. Liquidity is having cash available when you need it. And sometimes liquidity is worth more than returns. Sometimes having money you can access today is more valuable than money that might grow over 40 years. The people who sold stocks in 2007 before the crash and held cash, they didn't just avoid losses. They had capital to buy when everything was cheap in 2009. They actually came out ahead of the stay invested crowd. And let's talk about the lost decade. From 2000 to 2010, the S&P 500 went nowhere. If you invested at the peak in 2000, 10 years later you had basically the same amount, maybe less after inflation. A decade of your life where your investments did nothing. If you were 55 in 2000 and planning to retire at 65, that decade destroyed your plans. The long term didn't save you because you didn't have another long term. There is also a whole category of people who generate income from active trading. Day traders, swing traders, options traders. They don't wait 40 years. They generate cash flow monthly, weekly, even daily. Some of them make 6 figures or more per year doing this. They have income now, not in 4 decades. Are they taking more risk? Yes. But they also have income they can use today to pay bills, to invest in opportunities, to live life. Real-world evidence. Let me show you 2 different approaches to the same market. To the left, David. David followed the stay invested always rule religiously. He put money in index funds starting in 2000. He held through the dot-com crash, lost 50% of his portfolio. He held through the 2008 crash, lost 40% again. He held through the 2020 crash. Today, his portfolio has recovered and grown. He's up overall. The system worked. But it took him through 2 decades of emotional hell, and he's still not financially free. He's still working. Am I right, Michelle? Michelle sold most of her stocks in late 2007 when valuations looked insane to her. Everyone called her a market timer, told her she was being foolish. The market crashed in 2008. She avoided a 40% loss. In March 2009, when everyone was panicking, she bought back in at much lower prices. She outperformed the stay invested always strategy by over 30%. She also kept cash reserves that let her invest in a rental property in 2010 when real estate was cheap. That property has tripled in value. Her market timing worked because she wasn't trying to be perfect. She was just avoiding obvious extremes. So here's the question that cuts to the core. What if the long-term investor is just too scared to make active decisions? What if buy and hold forever is another way of saying, I don't trust myself to think, so I'll just do nothing? Is that wisdom or is that paralysis? And more importantly, can you honestly say you would never sell? That if you lost your job, your spouse got sick, your kid needed something, you wouldn't touch those investments? Because if you might have to sell during a crash, then you're not really a long-term investor. You're just hoping you won't have an emergency. And hope isn't a strategy. Key takeaway, here's what I actually think. Long-term investing works beautifully if your life allows for it. If you have stable income, if you have a separate emergency fund, if you have no major life disruptions coming, if you can genuinely hold for decades, then yes, stay invested. But if you're starting late, if your income is unstable, if you have dependents who might need help, if you want flexibility, then you need some liquidity. You need a plan B for when life doesn't follow your spreadsheet. Don't put 100% of everything into long-term investments and then pray nothing goes wrong. That's not discipline. That's gambling that you'll get lucky. Build in room for life to happen, because it will. Counterargument number 5. Being reasonable is just being scared with better PR. Housel says, choose reasonable over irrational. One of Housel's most compelling arguments is this. The best investment strategy isn't the one that maximizes returns on paper. It's the one you can actually stick with emotionally. He tells the story of Harry Markowitz, who literally won a Nobel Prize for creating optimal portfolio theory, the math that tells you exactly how to allocate assets for maximum return per unit of risk. But when it came to his own retirement money, Markowitz didn't follow his own theory. He just split it 50-50 between stocks and bonds. Why? Because it felt reasonable. It let him sleep at night. Housel's point is that being reasonable beats being rational because reasonable means you'll actually stick with it. If the mathematically optimal strategy causes you so much stress that you panic and sell during a crash, then it wasn't optimal for you. Better to choose a less perfect strategy that you can maintain for decades. It's honest. It's psychologically aware. And for many people, it's exactly right. But what if reason is code for mediocre? Let me be blunt. When I hear reasonable, I hear scared. I hear I'm going to underperform and call it wisdom. I hear I don't trust myself, so pick something easy. Look, I understand the psychology. Market volatility is emotionally difficult. Watching your portfolio drop 40% is genuinely painful. But here's the thing. If you can't handle volatility, maybe you shouldn't be investing in stocks at all. If you need to water down your strategy to feel comfortable, maybe you haven't educated yourself enough. Maybe the problem isn't that you need a reasonable strategy. Maybe the problem is that you need more knowledge and more emotional discipline. Think about the most successful investors in history. Warren Buffett, Charlie Munger, Ray Dalio, Paul Tudor Jones. Do you think they pick comfortable strategies? Do you think they say, well, this allocation makes me feel emotionally good, so I'll do it even though it's suboptimal? Hell no. They pick strategies that maximize returns, and they develop the emotional discipline to stick with them. That's the difference. They built their emotional capacity up to match the optimal strategy, rather than dumbing down the strategy to match their emotional weakness. Here's what nobody wants to admit. Reasonable investing often means leaving massive amounts of money on the table. Let me give you an example. From 2010 to 2020, if you invested in a balanced 50-50 stock-bond portfolio because it felt reasonable, you got about 9% annual returns. Not bad, comfortable, easy to stick with. But if you went 100% stocks, which felt unreasonable and scary, you got 13.9% annual returns. On a $100,000 investment, that's the difference between $237,000 and $370,000. That's $133,000 you gave up for comfort. Was that comfort worth $133,000 to you? And let's talk about 2020, the COVID crash. March 2020, the market dropped 34% in a month. The reasonable investor panicked. They felt sick. They maybe sold some positions to reduce risk. The unreasonable investor who could handle discomfort, and maybe even bought more. By the end of 2020, the market was up 16% for the year. By the end of 2021, it was up over 100% from the bottom. The unreasonable investors doubled their money. The reasonable investors protected themselves from gains. The biggest returns in investing come from the times that feel the most uncomfortable. That's not a coincidence. That's the entire game. If you're not willing to be uncomfortable, you're not willing to be rich. Real-world evidence. Let me show you two investors during the 2020 crash. On the left, Robert. Robert had a reasonable portfolio, 60% stocks, 40% bonds. When the crash hit in March, he felt sick. He was losing sleep, so he rebalanced to 40% stocks, 60% bonds. It felt better. I could sleep. He felt like he was being smart and prudent. By the end of 2021, his portfolio was up about 35% from pre-crash levels. Not bad. He survived. On the right, Angela. Angela was 100% stocks, all in on index funds. When the crash hit, she watched her portfolio drop 34% in a month. She didn't sleep well. She felt sick too. But she did something different. She educated herself on market history. She reminded herself this was temporary. She even borrowed money to invest more. By the end of 2021, her portfolio was up 106% from the crash bottom. She more than doubled her money. Same market, different emotional capacity, different results. Robert made the reasonable choice. Angela made the uncomfortable choice. Angela retired at 38. Robert is still working. So here's what you need to ask yourself, and this might sting. Is reasonable investing actually wisdom, or is it just an excuse for being afraid? Are you being prudent, or are you being weak? When you say I need a strategy I can stick with emotionally, are you being self-aware, or are you giving yourself permission to underperform? Because here's the uncomfortable truth. The market doesn't reward emotional comfort. The market rewards people who can do the right thing when it feels wrong. So which are you? Are you developing the emotional strength to handle the optimal strategy, or are you finding sophisticated ways to justify mediocrity? Key takeaway. Here's my honest take. If you genuinely cannot handle the emotional swings of an aggressive strategy, then Housel is right. Pick something reasonable that you can maintain. Better to get 8% that you stick with than 12% that you abandon. But don't confuse emotional weakness with wisdom. Don't pretend that underperformance is sophistication. If you're choosing the reasonable path, make sure you're doing it from a place of genuine self-acknowledge, not fear. And ideally work on building your emotional capacity. Read about market history. Understand cycles. Practice detachment. Because the ability to be uncomfortable is worth millions of dollars. Literally, the question isn't what strategy feels good. The question is, can I develop the discipline to stick with what works? That's the real skill. Counterargument number 6. Wealth is what you see, and that's okay. House says wealth is invisible. One of my favorite lessons in the book is this. Wealth is what you don't see. It's not the car someone drives. It's the car they could have bought but didn't. It's not the watch. It's the money sitting in investments instead of on their wrist. Housel tells the story of a janitor, Ronald Reed, who died with $8 million in the bank. Nobody knew. He drove old cars, wore cheap clothes, lived modestly. Meanwhile, countless executives and professionals who looked wealthy died broke. The lesson: we confuse spending with wealth. Real wealth is invisible. It's the money you haven't spent yet. It's the car you didn't buy, the vacation you skipped, the lifestyle inflation you resisted. And this is genuinely profound wisdom for most people. But what if it's incomplete? But what if visible success creates opportunities? Okay, let's talk about something that makes people uncomfortable. Appearances matter. Not because they should, but because they do. In business, in networking, in opportunity creation, how you present yourself affects how people perceive your competence, your success, your credibility. Like it or not, that's reality. There's actually a famous saying in business, your network is your net worth. And how do you build a powerful network? Part of it is by signaling that you're someone worth knowing, that you're successful, that you're going places. And sometimes strategic spending on appearance is an investment, not an expense. Let me give you a real example. to a financial advisor who drives a beat-up 20-year-old car because he's too smart to waste money on depreciating assets, and another advisor who drives a nice Mercedes. Which one do you think attracts more high-net-worth clients? Is the Mercedes driver? Why? Because rich people assume that if you're driving an old beater, you're not successful, which means you're probably not good at managing money. Fair? No. Yes. The Mercedes isn't just a car. It's a marketing tool. It's a signal. And if it brings in 3 new wealthy clients per year, it pays for itself 10 times over. Or think about clothing. Steve Jobs wearing a black turtleneck. That's a billionaire who earned the right to dress however he wants. But if you're 28 trying to close deals, build relationships, get promoted, showing up in ratty clothes, because stealth wealth doesn't work in your favor. It works against you. You're signaling that you don't care, that you're not successful yet, that you're not someone to take seriously. Again, fair? Context matters. What stage of your career are you in? What industry are you in? What are you trying to build? Here's another angle. Joy? Sometimes buying nice things brings genuine joy, enhances your life, makes you happy. And if you can't afford it, if it's not going to bankrupt you, why shouldn't you? What's the point of making money if you never use it to improve your life? Housel talks about his paid-off house bringing peace. That's spending money for emotional benefit. How is that different from someone buying a sports car that brings them joy every time they drive it? It's not. It's the same trade-off. Money for emotional well-being. One just looks more responsible than the other. And let's be honest, the stealth wealth philosophy often comes from people who are already wealthy, already established, already have credibility. It's easy to say don't spend money on appearances when you're a millionaire author who doesn't need to impress anyone anymore. But when you're starting out, when you're building, when you're trying to open doors, strategic, visible success can accelerate your path. It can create opportunities that wouldn't exist otherwise. The question isn't, should I ever spend money on visible things? The question is this visible spending creating value for me, or am I just feeding my ego? Big difference. Real-world evidence. Let me show you 2 entrepreneurs. On the left, Marcus. Marcus believed deeply in stealth wealth. He drove a 15-year-old Toyota. He wore cheap clothes. He avoided any appearance of success because he was too smart for that. He was building a consulting business. But here's what happened. Potential clients didn't take him seriously. When he showed up to pitch a Fortune 500 company driving that old Toyota, wearing a wrinkled shirt, they assumed he wasn't successful. They assumed he didn't have other clients. They passed. His stealth wealth cost him deals. Eventually, he figured it out, upgraded his appearance, and his business tripled. On the right, Jennifer. Jennifer bought a luxury car lease when she started her business. Even though financially it was tight, she bought quality clothes. She looked successful before she was. When she walked into meetings, people assumed she was already established. They wanted to work with her. Her appearance opened doors. 3 years later, she sold her business for 7 figures. Was the luxury car the reason? No, but it helped create an image that attracted opportunity. Sometimes spending money on appearance is the smartest investment you can make. So here's the tough question. Is the invisible wealth advice actually wisdom? Or is it just sour grapes from people who can't afford nice things rationalizing their situation? Is it possible that some of us are using stealth wealth as an excuse to not invest in our appearance, our brand, our positioning, because we're afraid or we don't understand marketing? And here's the deeper question. What if enjoying your money while you're young enough to enjoy it is actually smarter than dying rich? What if the janitor with $8 million who lived in poverty his whole life isn't an inspiration but a cautionary tale about taking frugality too far? Key takeaway. Here's what I believe. Don't go broke trying to look rich. That's stupid. If you're financing luxury to impress people who don't care about you, you're a fool. But if you can afford something, if it brings genuine joy or creates genuine opportunity, if it's strategic spending rather than ego spending, then buy it. Enjoy it. Use your money. The question you need to ask is, why am I buying this? If the answer is to impress strangers, don't buy it. If the answer is because it brings me joy or because it creates business opportunity, then maybe do buy it. Context matters. Your situation matters. One size does not fit all. Know yourself. Know why you spend, and be honest about whether you're being strategic or just justifying bad decisions. Counter-argument number 7. You can time the market, sort of. Housel says, market timing fails. Housel is very clear about this. Don't try to time the market. Stay invested always. Never try to predict tops and bottoms. He cites statistics showing that 85% of active mutual funds underperformed their benchmarks over 15 years. He shows that if you miss just the 10 best days in the market over several decades, your returns are cut in half. The message is loud and clear. You can't time the market. Nobody can. Stop trying. Just stay invested. And for most people, this is absolutely true. Most people who try to time the market fail miserably. They sell low out of fear and buy high out of greed. They do exactly the opposite of what they should do. But here's what Housel doesn't tell you. But what if valuation actually matters? Okay, let's separate two different things. Trying to time the market perfectly and paying attention to basic valuation. Perfect timing, selling at the exact top, buying at the exact bottom, that's impossible. Nobody can do it consistently. But recognizing when valuations are extremely expensive or extremely cheap, that's not only possible, it's smart. Let me give you an example. In 1999, the dot-com bubble, the S&P 500 was trading at a P/E ratio of over 30. Historically, the average is about 16. When you buy at a P/E of 30, your expected returns over the next 10 years are much lower than when you buy at a P/E of 15. This isn't magic, it's math. If you bought the S&P 500 at the peak in March 2000, by March 2010, you had basically zero returns. 10 years of nothing. But if you had said these valuations look insane, I'm going to hold more cash and wait, you would have avoided that decade of zero returns. And then when the market crashed in 2002 or 2008, you could have bought at much better valuations. The never time the market advice benefits Wall Street, not you. Think about it. Financial advisors make money based on assets under management. They want you fully invested at all times so they can collect their fees. If you hold cash, they make less. So they tell you market timing doesn't work, stay fully invested always. But here's the truth. Every major institution does some form of market timing. Pension funds adjust their allocation based on market conditions. Endowments shift between stocks and bonds. Even Warren Buffett, the god of long-term investing, holds massive amounts of cash when he thinks valuations are too high. In 2021, Berkshire Hathaway had over $150 billion in cash because Buffett couldn't find anything worth buying at those prices. He was timing the market by waiting for better opportunities. Now, I'm not saying you should try to trade in and out every week. I'm not saying you should panic sell every time the market dips 5%. That's idiotic. But I am saying that paying attention to basic valuation metrics like P/E ratios, price to sales, market cap to GDP, and adjusting your allocation when things get extreme is not only reasonable, it's smart. When stocks are historically expensive, maybe hold 20 or 30% cash instead of being 100% invested. When stocks are historically cheap, maybe be 100% invested or even use some leverage. It's not market timing. That's basic risk management. The people who say you can't do any form of timing are either ignorant or they have an incentive to keep you fully invested regardless of price. Real-world evidence. Let me show you two investors in 2007. And on the left, Sarah. Sarah followed the never time the market rule. She was 100% invested in stocks. In October 2007, the market peaked. Over the next 18 months, she watched her portfolio drop 57%. She held on like she was supposed to. By March 2009, she was down massively. She eventually recovered, but it took until 2013 to get back to even. 6 years of emotional torture. On the right, Mike looked at valuations in 2007. Home prices were insane. Subprime lending was everywhere. Stock valuations were elevated. He didn't try to predict the exact top, but he said, "This doesn't feel right. I'm going to move to 50% cash." Everyone told him he was market timing, that he was going to miss out on gains. The market crashed. He didn't lose 57%. He lost about 28% because half his money was in cash. Then, in March 2009, when everyone was panicking, when Sarah was paralyzed with fear, Mike deployed that cash. He bought at deeply discounted prices. By 2013, Mike's portfolio was up 85% from pre-crash levels. Sarah's portfolio was finally back to even. Mike outperformed by paying attention to valuation. He didn't time it perfectly. He didn't need to. He just avoided the obvious extreme and took advantage when prices got cheap. So here's what you need to ask. If market timing never works, why does every major institution do it? Why do pension funds adjust allocations? Why do endowments rebalance based on market conditions? Why does Warren Buffett hold $150 billion in cash sometimes? Either they're all stupid, or the never time the market advice is oversimplified to the point of being wrong. My guess? It's the latter. The truth is, perfect timing is impossible. But basic awareness of valuation extremes is not only possible, it's prudent. So the question isn't, should I time the market? The question is, should I pay attention to price, or should I blindly buy no matter what things cost? Which sounds smarter to you? Key takeaway. Here's my take. Don't day trade. Don't try to predict every little wiggle in the market. Don't panic sell every time there's a 5% dip. That's all stupid. But do pay attention to basic valuation. When stocks are extremely expensive by historical measures, maybe hold 20 to 30% cash. When stocks are extremely cheap, maybe be fully invested or even use some leverage if you understand the risks. That's not market timing. That's paying attention to price. Would you buy a house without looking at the price? Would you buy a car without negotiating? Then why would you buy stocks without caring about valuation? The never time the market crowd wants you to turn off your brain. I'm saying turn it on. Be aware, be thoughtful, and don't confuse trading with allocation. They're different things. Counterargument number 8. Savings rate doesn't matter if income is too low. Housel says savings rate greater than returns. One of Housel's most powerful insights is that your savings rate matters more than your investment returns. He argues that you have more control over how much you save than over what the market returns. And mathematically, he's right. If you save 50% of your income versus 10%, that 5 times difference will compound dramatically over time. It's empowering advice because it puts control back in your hands. You can't control the market, but you can control your savings rate. And for many people, this is exactly the mindset shift they need. Stop obsessing over finding the perfect investment. Start obsessing over saving more. That's great advice, but it has a massive blind spot. But what if you can't save your way to wealth on 40K? Let me do some brutal math that Housel conveniently skipped. Let's say you make $40,000 a year. That's close to median household income in many parts of America. You follow Housel's advice and save 20% of your income. That's $8,000 per year. Fantastic. You invested in index funds getting 8% annual returns. After 30 years, you have about $980,000. Sounds great, right? Except inflation means that $980,000 in 30 years has the purchasing power of maybe $450,000 today. And you're still not financially free? You still need to work into your 60s or 70s. Now let's say you get hardcore about savings rate. You save 50% of your $40,000 income. It's $20,000 per year. Extremely difficult. You're living on $20,000 a year before taxes. You're eating rice and beans. You're never going out. You have no life. And for 30 years, you have about $2.4 million. But again, inflation adjusted, that's maybe $1.1 million in today's money. and you sacrifice 3 decades of enjoying life to get there. Here's the uncomfortable truth. Below a certain income level, savings rate advice becomes almost insulting. It's like telling someone drowning to swim harder. If you're making $30,000 or $40,000 or even $50,000 in a high cost of living area, you're not saving your way to wealth. You're surviving. The real problem isn't that you're not saving enough. The real problem is that you're not earning enough. This is what drives me crazy about blanket financial advice. It ignores systemic issues. It ignores the fact that wages haven't kept pace with productivity for 40 years. It ignores that healthcare costs, education costs, and housing costs have exploded while median wages have stagnated. It ignores that a single medical emergency can wipe out years of savings for people without good insurance. The obsession with savings rate also misses opportunity cost. Let's say you're making $50,000 a year and you're focused intensely on saving 30% of it. That's $15,000 per year. But what if instead of obsessing over cutting your latte budget, you spent that mental energy on increasing your income? What if you learned new skills, switched careers, started a side business, got a better job? What if you jumped from $50,000 to $100,000 in income? Suddenly you can save $30,000 per year without sacrificing your quality of life. That's double the savings with less pain. Income growth is a multiplier. Savings rate is addition. In the early years of your career, time spent increasing income is almost always more valuable than time spent optimizing your budget. Real-world evidence. Let me show you 2 people at age 25. On the left, Jessica. Jessica makes $45,000 a year. He reads personal finance advice about savings rate. She cuts every possible expense. She lives with roommates. She never eats out. She bikes instead of driving. She saves 25% of her income, $11,250 per year. She's proud. She's disciplined. Fast forward 10 years. She's 35. She's saved diligently. Her portfolio is worth about $175,000. She still makes $52,000 because she focused so much on savings that she didn't invest in career growth. On the right, David. David also makes $45,000 at age 25, but he takes a different approach. He saves a modest 10%, just $4,500 per year. But he spends money on education. He gets certifications. He networks. He switches jobs strategically. By age 30, he's making $85,000. By 35, he's making $130,000. Even though he's only saving 15% now, that's $19,500 per year. His portfolio at 35 is worth about $180,000, similar to Jessica's. But his income is 2.5 times higher. His future trajectory is completely different. But he can now save massive amounts without pain. Jessica optimized savings rate. David optimized income growth. David's strategy was smarter. So here's the question that cuts through the noise. Is the high savings rate advice realistic and helpful for everyone, or is it primarily advice for people who already make good money? If you're making $30,000 or $40,000 a year with student loans and living in a city where rent takes half your paycheck, is telling you to just save more actually helpful? Or is it ignoring the real problem? That wages are too low and costs are too high. What if the focus on savings rate is another way of putting all the responsibility on individuals while ignoring systemic economic issues that make it nearly impossible for many people to get ahead no matter how disciplined they are? Key takeaway. Here's what I think. Savings rate absolutely matters. If you're making 6 figures and saving 5%, you're doing it wrong. You should be saving way more. But if you're making $40,000 a year, obsessing over saving 20% while ignoring income growth is a mistake. When you're young and your income is low, your number 1 priority should be increasing your income. Learn skills, switch jobs, start a side business, network aggressively, get your income up first, then optimize savings rate. Because saving 50% of $40,000 is $20,000. But saving 20% of $150,000 is $30,000. Same savings rate, but way more money and way less pain. The question isn't just how much should I save? The question is, am I earning enough for savings rate to even matter? If not, focus on income first. Counterargument number 9. You do need to beat the market. Housel says index funds are enough. Housel makes a compelling case for index fund investing. He shows that over 85% of professional fund managers failed to beat the market over 15 years. He argues that trying to pick individual stocks is a fool's errand. Just buy a low-cost index fund, get market returns, and you'll beat almost everyone. And historically, he's right. The average investor would be far better off just buying an S&P 500 index fund and holding forever than trying to pick stocks or hiring expensive active managers. It's simple. It works. It requires almost no skill. For most people, it's perfect advice. But what if you're not most people? But what if market returns aren't enough? Okay, let's talk about what market returns actually means. The S&P 500 has historically returned about 10% annually. Sounds great, but that's before inflation, which averages about 3%. So your real return is 7%, and that's before taxes. If you're in a taxable account, you're paying capital gains taxes, maybe another 1 to 2% drag. So your real after-tax return is maybe 5 to 6%. Now, if you're 25 with 40 years ahead of you, that compounds nicely. But what if you're 35 and just starting? What if you're 45 and way behind? 5 to 6% real returns might not get you where you need to go fast enough. Here's what nobody wants to say out loud. If you're starting late, you need to beat the market. You don't have the luxury of average returns. You need above-average returns to catch up. And yes, that means taking more risk. That means getting more concentrated. That means educating yourself and actively managing your investments instead of just being passive. Index funds are great for people with time, but if you don't have time, you need a different strategy. Think about it this way. If you have 20 years to retirement and you need $2 million, getting 7% real returns might get you there if you save aggressively. But what if you only have 10 years? You might need 15% returns. You can't get 15% from index funds. You need concentration. You need asymmetric bets. You need to take calculated risks. And let's be honest about something else. The biggest wealth in history wasn't built with index funds. Jeff Bezos didn't index fund his way to being the richest person on earth. He went all in on Amazon. Elon Musk didn't diversify into index funds. He went all in on Tesla and SpaceX. Every major fortune was built through concentration, not diversification. Now, I'm not saying you should put everything into one stock and pray. It's gambling. But I am saying that strategic concentration on things you understand deeply can generate life-changing returns that index funds never will. Peter Lynch, one of the greatest investors ever, said you only need a few big winners in your lifetime. You don't need to be right on everything. You need to be massively right on a few things. That's concentration, not diversification. Here's another angle: real estate. If you buy rental properties with leverage, you can generate 15 to 20% annual returns, including appreciation and cash flow. That's double what you get from index funds. Is it more work? Yes. Is it more risk? Yes. But it's also way more return. The just index fund everything advice assumes everyone has the same goals, the same timeline, the same risk tolerance. But what if your goal is to retire in 10 years, not 40? What if you're willing to work harder and take more risk for higher returns? Then index funds might not be enough. They might guarantee you mediocrity when you need exceptional, real-world evidence. Let me show you two investors in 2015. On the left, Mark. Mark put everything into a total stock market index fund. He invested $100,000. He added money every year. By 2025, his portfolio grew at about 9% annually. He turned $100,000 into about $240,000. Solid, reliable. On the right, Lisa. Lisa put $50,000 into index funds for safety. But she also put $50,000 into what she called her conviction portfolio. 5 tech stocks she researched deeply: Amazon, Microsoft, Nvidia, Tesla. She believed in these companies. She understood their businesses. She held through volatility. By 2025, her index fund portion grew to $120,000. But her conviction portfolio grew to $450,000. Total, $570,000. Same starting capital as Mark, more than double the result. Was she lucky? Maybe partially. But she also did research. She made informed bets. She concentrated on things she understood. She got paid for that extra effort and extra risk. So here's what you need to ask yourself. Is the just buy index funds advice actually optimal? Or is it advice designed to keep regular people from threatening the wealthy? Think about it. Institutional investors don't just buy index funds. They pick stocks. They invest in private equity. They use leverage. They concentrate their bets. Meanwhile, they tell you to just buy the index and accept average returns. Why? Because if everyone tried to beat the market, they'd be competing with the institutions. It's easier for them if you just accept average. So the question is, do you want to settle for average, or do you want to put in the work to potentially do better? Neither answer is wrong, but be honest about which one you're choosing. Key takeaway. Here's my take. Index funds are great. They're safe, reliable, low effort, and they beat most active investors. If you want a hands-off approach and you have plenty of time, index funds are perfect. But if you're starting late, if you need above-average returns to reach your goals, if you're willing to put in the work to research and understand individual investments, then strategic concentration might be better for you. The key word is strategic, not gambling, not throwing money at meme stocks, but concentrated bets on things you've researched and understand. My approach? Put 80% in boring index funds. Put 20% in concentrated bets where you have an edge, where you've done the work, where you have high conviction. That gives you safety and upside. You don't need to choose between index funds and active investing. You can do both. The question is, what mix is right for your situation? Counterargument number 10, optimism is dangerous without a safety net. Housel says, be optimistic long-term. One of the most inspiring parts of the book is Housel's case for long-term optimism. He shows that over the last 170 years, despite wars, depressions, pandemics, crashes, and countless crises, the stock market has gone up, way up, tens of thousands of %. His message is clear: bet on progress, bet on human ingenuity, bet on things getting better over time. And the data backs him up. Pessimists sound smart in the moment, but optimists make money over decades. It is genuinely inspiring, and it is true. But here is what worries me about this advice. But what if blind optimism bankrupts people? Let me tell you 3 stories. Story 1, 2007. Housing prices had been going up for years. Everyone said real estate always goes up. It is a safe investment. People bought houses they could not afford with mortgages they did not understand because they were optimistic. Then 2008 happened. Millions lost their homes. Millions lost their savings. Their optimism destroyed them. Story 2, 2000. The internet is the future. .com stocks are can't-miss investments. It is a new economy. Old rules do not apply. People quit their jobs to day trade. People mortgaged their houses to buy tech stocks. Then the bubble burst. The Nasdaq dropped 80%. Fortunes evaporated. Optimism without caution ruined lives. Story 3, 2021. Crypto's going to the moon. Just hodl, diamond hands, we are all going to be rich. People took out loans. People emptied their savings. Then 2022 happened. Crypto winter. Bitcoin dropped 70%. Many altcoins dropped 90% or more. People lost everything because they were too optimistic. Here is the pattern. Optimism feels like wisdom right up until the moment it becomes stupidity. Yes, markets recover eventually, but eventually assumes you can survive until recovery happens. And that is a big assumption. If you are fully invested with no cash reserves, no safety net, and the market crashes 40%, what happens? If you lose your job during that crash, you are forced to sell at the bottom. You'll lock in losses you can never recover. Your optimism killed your financial future. The problem with markets always recover is that it ignores the individual's ability to hold on during the crash. It assumes you have unlimited time. It assumes you don't need money during the crash. It assumes you can emotionally and financially survive the pain. Nassim Taleb wrote a whole book about this called The Black Swan. His point, the biggest risks are the ones you don't see coming. The outlier events, the things that happen once every 50 or 100 years. And if you're optimistically fully invested when one of those black swans hits, you're done. You wiped out. The people who survive black swans are the pessimists with cash. The people who said maybe things won't always go up. The people who built safety nets. The people who were paranoid. Michael Burry, who predicted the 2008 crash, made $800 million. How? By being pessimistic when everyone else was optimistic. By betting on disaster. By preparing for what optimists refuse to see. Here's what nobody tells you. There's a balance between optimism and paranoia. You need to be optimistic about long-term trends. But you also need to be paranoid about short-term disasters. That's what Taleb calls being anti-fragile. You position yourself so that when chaos happens, you don't just survive, you thrive. You have cash to buy when everything is on sale. You have optionality. You have breathing room. Blind optimism is dangerous. Optimism with a backup plan is smart. The question isn't, should I be optimistic? It's, what happens if I'm wrong? Real-world evidence. Let me show you two investors during the 2008 crash. On the left, Tom was optimistic. He believed in America. He was 100% invested in stocks. Zero cash. Why hold cash? Cash loses to inflation. Stocks always go up long-term. Then the crash hit. His portfolio dropped 57%. He held on. He stayed optimistic. But in 2009, he lost his job. He needed money to live. He was forced to sell stocks at the bottom to pay rent and buy food. He locked in massive losses, and his optimism destroyed him. By the time he got back on his feet years later, the market had recovered, but he wasn't in it anymore. He missed the entire recovery. On the right, Karen was optimistic about the long term, but paranoid about the short term. She kept 30% of her portfolio in cash. Her friends called her crazy. You're losing to inflation, you're missing gains. Then the crash hit. Her stock portfolio dropped 57%, same as Tom's. But she had cash. She didn't panic. She didn't need to sell. In March 2009, when everyone was panicking, she deployed that cash. She bought stocks at bargain prices. By 2013, she had doubled her net worth from pre-crash levels. Her paranoia saved her. Her cash gave her optionality. So here's the question that should keep you up at night. When does healthy long-term optimism become reckless short-term denial? How do you know if you're being appropriately optimistic or dangerously blind? And more importantly, what happens to your optimism when you lose your job, your spouse gets sick, your kid needs something expensive, and the market is down 40%? Because that's when your philosophy gets tested. That's when you find out if your optimism was wisdom or just luck that you hadn't been punched in the face yet. So, are you really optimistic, or are you just gambling that nothing will go wrong? Key takeaway. Here's what I believe. Be optimistic about the long term, absolutely. Human ingenuity is real. Progress is real. Things generally get better over decades. But be paranoid about the short term. Always have cash reserves. Always have a backup plan. Always ask yourself, what if I'm wrong? What if disaster strikes tomorrow? Can I survive? Optimism without liquidity is just hope. And hope is not a strategy. The smartest approach is what Taleb calls the barbell. Be aggressively optimistic with most of your money. Invest in stocks. Build businesses. Take risks. But be extremely paranoid with some of your money, hold cash, build safety nets, prepare for disasters. That way, when the black swan comes, and it always comes eventually, you don't just survive, you thrive. Because you have the cash to buy when optimists are panic selling. That's not pessimism. That's smart optimism. Final synthesis. All right, we just went through 10 massive counterarguments to one of the most popular personal finance books ever written. And if you are feeling a bit confused or overwhelmed right now, that is actually good. That means you are thinking instead of just blindly accepting. So let us step back and look at the pattern here. What did we learn? First, both sides have valid points. Morgan Housel is not wrong. His advice is solid, proven, and helpful for millions of people. But the opposite view is not wrong either. There are situations where his advice does not fit. There are contexts where doing the opposite makes more sense. The book is not universal truth. It is one perspective based on one person's experience, values, and life situation. Second, context matters more than advice. What is right for a 50-year-old millionaire with no debt might be completely wrong for a 25-year-old with student loans. What works for someone with stable income and 40 years ahead of them might be disastrous for someone who needs wealth in 10 years. What makes sense for someone with low risk tolerance might be leaving money on the table for someone who can handle volatility. You cannot separate the advice from the person it is given to. One size does not fit all, ever, in anything, and especially not in personal finance. Third, your situation will change. What is right for you today might be wrong for you in 5 years. You might need the be patient advice in your 20s and 30s, but need the move faster advice in your 40s if you are behind. You might need the avoid debt advice when you are financially uneducated, but benefit from leverage once you understand how it works. You might need the index fund everything approach when you are starting out, but benefit from concentration once you develop expertise. Financial wisdom is not static. It evolves as you evolve, as your income changes, as your knowledge grows, as your life circumstances shift. You need to revisit your strategy regularly and be willing to change course when your situation changes. The decision framework. So how do you decide which philosophy is right for you? Let me give you a framework. Housel's advice works best if you have these characteristics: stable income, long time horizon of 20 years or more, low to moderate risk tolerance. You value peace of mind over maximum optimization. You are already making decent money, let us say $75,000 or more annually. You have no crushing debt killing you, and you want a hands-off approach. If that describes you, follow Housel's advice. You will do great. But the opposite approach might work better if you have these characteristics. Short timeline. You need wealth faster. You have high income or the ability to significantly grow your income. High risk tolerance. You are financially educated or willing to become educated. You are willing to be emotionally uncomfortable in pursuit of goals. And you have specific, ambitious goals with deadlines. If that describes you, you might need more aggressive strategies. But here is the thing most people miss. You do not have to choose one or the other entirely. You can blend both approaches. You can use what I call the barbell strategy. Put 80% of your wealth into Housel's boring advice. Index funds, high savings rate, patience, room for error, long-term thinking. That is your safety. That is your foundation. But put 20% into the opposite approach. Calculated risks, concentrated bets, asymmetric opportunities, aggressive income growth, strategic leverage if you understand it. That is your upside. That is your moonshot. This way, even if your aggressive bets fail completely, you are still fine because 80% is safe. But if your aggressive bets succeed, they can dramatically accelerate your path to wealth. You get safety and opportunity. You do not have to choose. The key is knowing yourself. Brutal honesty. Are you choosing patience because it is right for you or because you are afraid? Are you choosing aggression because you are strategic or because you are desperate? Are you avoiding debt because you do not understand it, or because you genuinely prefer the peace of mind? Are you picking index funds because they are optimal for your situation, or because thinking about individual stocks is too much work? These questions matter. Self-awareness matters more than any particular strategy. Because the best strategy executed poorly is worse than a mediocre strategy executed perfectly. Know yourself first, then pick your approach. Warning symbol. Let me give you one final warning. Both extremes are dangerous. If you follow Housel's advice too strictly, if you are too conservative, too patient, too afraid to take any risk, you might play it so safe that you never build real wealth. You will be comfortable but never free. You will get to 65 and realize you could have done more, could have pushed harder, could have taken smarter risks. You optimized for safety and gave up opportunity. That is one trap, but the other extreme is just as dangerous. If you are too aggressive, too impatient, too concentrated, too leveraged, you might blow up your entire financial life. You might take risks you do not understand. You might confuse calculated risk with gambling. You might bet everything and lose everything. That is the other trap. Scene change, flowing river. The wisdom is in the middle. Or more accurately, the wisdom is in knowing when to be conservative and when to be aggressive. When to be patient and when to move fast. When to diversify and when to concentrate. When to use debt and when to avoid it. Context determines everything. Your age, your income, your knowledge, your goals, your timeline, all of these factors determine which approach is right for you right now. And right now is the key phrase. Because what is right changes. You need to be adaptable. You need to think. You need to know yourself. And you need to be willing to change your mind when your situation changes. So here is your homework. And I mean this seriously. Do not just follow this book blindly. Do not follow my advice blindly. Do not follow anyone blindly. Here is what you should actually do. First, know your numbers. What do you actually make? What do you actually spend? What do you actually have saved? What do you actually owe? Write it down. Look and be honest. Second, assess your risk tolerance honestly, not how you wish it was. I know what sounds cool to say. How it actually is. Can you really hold through a 40% crash? Have you ever been tested? Third, choose 3 to 5 lessons from this book that actually fit your situation. Not all 20. It's not 0. 3 to 5 that make sense for where you are right now. Fourth, ignore the advice that does not match your situation. Do not feel guilty about it. Different advice fits different people. That is fine. Fifth, revisit this every year. Your situation will change. Your income will change. Your knowledge will change. Your goals will change. What is right this year might be wrong next year. Stay flexible. And finally, remember this. The best financial advice is advice you will actually follow. Whether that is Housel's approach, the opposite approach, or some blend of both. The worst thing you can do is nothing. The absolute worst strategy is paralysis. Because any plan, even an imperfect plan that you execute consistently, beats no plan. So pick your path, commit to it, execute it, and adjust as you go. That is how you build real wealth. Not by following a book, by thinking for yourself. All right, we covered a lot. 10 counter-arguments, 20 perspectives, 1 goal, helping you think critically instead of following blindly. So let me ask you, which counter-argument hit you the hardest? Which one made you uncomfortable? Which one challenged something you believed? Drop a comment and let me know. Are you Team Housel? Conservative, patient, long-term focused? Are you team opposite? Aggressive, fast-moving, calculated risk-taker? Or are you like me? Team both, taking the barbell approach, blending safety with opportunity? There is no wrong answer. There is only honest answer. And whatever your answer is, own it. Commit to it. Execute it. If this video made you think differently about money, if it challenged you, if it gave you a new perspective, hit that subscribe button. because I am going to keep making videos that question conventional wisdom, that challenge popular advice, that force you to think instead of just consume. Question everything, even this video. And remember, question everything. In this video, especially this video, because the goal is not for you to believe me. The goal is for you to think for yourself. That is how you win. Now go build your wealth your way.